There wasn't a great deal of trading, but European shares rose on Wednesday after the cost of selling short-term Italian debt halved. A new austerity package in Italy and cheap long-term liquidity from the European Central Bank meant €9 billion of sixth-month bills sold for an average of 3.25%, half what they cost a month ago. Demand for them was also up. There's now optimism about an auction of longer-term Italian debt on Thursday. Manoj Ladwar, a senior trader at ETX Capital, says investors are getting used to costly sovereign debt.
There does seem to be the so-called new normal within the markets whereby investors are becoming more and more comfortable with higher bond yields. We've got to remember that Italy is not Greece. It does have a valid tax collection structure in place. It does have an export market, an import market, etc. So it's a bona fide economy, and it's able to sustain yields well above 7% and probably closer to 9%, maybe even 10% before it turns around to the EU and looks for a bailout.
The auction was the first since the ECB provided €490 billion in cheap three-year loans to Eurozone banks. The unprecedented move last week was aimed at easing credit strains in the hope of improving the debt crisis. Since then, bank-to-bank lending has fallen. Wednesday saw a fifth drop in a row, and banks still seem to be nervous of lending to each other. Latest figures show they've deposited €452 billion at the central bank, a record high, after choosing the safer low-interest option for their cash. Some analysts now believe the ECB will further cut interest rates if the Eurozone economy continues to decline. Sonia Legg, Reuters.